Hello, and welcome to Chapter 3 homework. We're going to discuss how to basically do the homework and try to use some items that you may actually get confused on, especially the way sometimes Connect works. Here, again, look, you have unlimited chances, and look at the due date for which class you're in. Again, due dates change. So, again, you can either go through your Connect website, or you can go through Blackboard to whatever chapter we are. Also, we always vary. You can save and exit, and you can hit submit. Once you hit submit, though, it's graded, and then you have to do another attempt. But you have a limited, so more power to you. So just like chapters 1 and 2, you can see either hints or ebooks on this side. And we tend to start again with some videos. So let's go through all the videos, 4, 5, and then we wind up with question number 6. So question number 6 basically wants to see how well you can understand what are the following types of adjusting entries we deal with. One is dealing with prepaid expenses. Next is dealing with unearned revenue. Then we have accrued expenses and accrued revenue. So basically you're going to take the situation at hand and see if it falls in one of those four places. Now again, just like the previous chapters, yours may actually change to what you see in the video. And again, this is just to show you how to work these problems. If they're the same, well, more power to you. Got some good answers. Okay, starting off with A. We're going to record rent expense incurred but not yet paid. Anytime that we have an expense that has been incurred but we haven't paid it, it's like a running bill. That just means that we're going to end up accruing that expense because it has incurred and we have to recognize it. This could have happened that we got the bill on December 30th, so we know rent has basically happened, but we just haven't got time to pay for it, or the due date's later, but it's still there. It has happened. So GAAP says we have to. So when I see that, again, I want to click on the drop down, and accrued expenses just happens to be the first one. There we go. Cool. B, to record cash received from gift card sales. This one's a little bit tricky. Okay? This one actually sounds like revenue. Revenues happen. We received cash. We did gift card sales. But remember the nature of gift cards. Gift cards is for some other kind of product, like Starbucks. You get a Starbucks gift card, you give that to someone. Well, do they have Starbucks? Do they have that product? No, they actually have to take that gift card, go to a Starbucks store, and redeem it. Well, with this is, let's just take Starbucks as themselves. So Starbucks, they sold the gift card. Did they actually get a product? Did they perform a service? No, not really. They didn't give coffee, their number one product. They just gave a gift card to be redeemed later. So when it's redeemed later, that's when they actually earned the money of doing the gift card. So some of these companies, due to this aspect, would actually have a lot of money in their unearned revenue due to gift cards just not being redeemed. But that's something else. If you'd like to go into how this stuff works, you're more than welcome to email me and we can go over this. Okay? But since this is revenue that hasn't been earned yet because we haven't actually done the product, we just kind of gave them something to give to someone else or whatever and be redeemed later, that's known as the unearned revenue. Again, we haven't earned the cash yet. Next one, we record service revenues performed but not yet billed nor recorded. So again, we've done the service. We've basically earned it. We've earned it completely, but we haven't billed our client. So again, that journal entry dealing with accounts receivable. So since it's like that, it will be figured as accrued revenue. We accrue the revenue, we recognize the revenue, we probably will bill out the client next year and then receive the cash. To record the expiration of prepaid rent, okay, right there in the name itself says prepaid, so I'm probably figuring it's dealing with prepaid expenses, which is correct. Since again I bought the rent probably ahead of time, probably rented out the place for 3 months, and each time I do that I have to deal with prepaid expenses because it goes from prepaid rent to rent expense. Now E, to record supplies using as supplies expense. Supplies, like any other inventory type-ish account, is technically a prepaid account. Basically, from there, we take supplies used, or supplies that we've already bought, and once they have been expensed, or basically used, they go to their supplies expense account. So we have supplies just waiting there, kind of like an insurance policy. It's just there, and it slowly whittles down as we get closer to zero. So supplies is considered a prepaid account, which means we deal with prepaid expenses. Normally, again, prepaid expenses tend to deal with more asset bases. So of course, you can always hit check my work as you progress through and return to the question as you go through each one. This usually helps if you're kind of a little confused if you got the right one or not. But again, don't just go through each of the 4 and keep hitting check my work until you get to the right one. Understand these, because this is the start. I mean, these 3 chapters are very important. So you need to understand instead of just trying to just float through the homework as easy as possible. Okay. Question 7. Question 7 is a fun one. It starts with our prepaid expenses. So those last 2 that we just dealt with, we'll kind of go and get into them a little bit more. Here you're going to notice this in chapter 2 when we prepared journal entries. It basically gave us the full journal entry here, so we didn't have to go up and down. We don't get that luxury this time around with question 7. So here we're going to just read, see what happens, and analyze the situation. So on July 1st, 2017, Lopez Company paid $1,300 for 6 months of insurance coverage. Notice that no adjustment has been made to the prepaid insurance account, and it is now December 31st. So we have no adjustments whatsoever. We'll know we're dealing with the prepaid insurance account because it tells us prepaid insurance. But we should already know that because we have an amount that's during a period. So with that, let's take the dates. Let's see if we have anything left over into next year. So we only have 6 months. So with the 6 months, let's start, and it goes from July 1st. Now notice it's the start of July. So we get to count July because we use it for the whole month. So July, August, September, October, November, and December. So that's 6 months right there to get to December 31st. So since it only lasted for 6 months, it was 6 months at the end of December 31st, we actually used the whole item, or the whole insurance policy. So when we go down here, always watch out. Again, enter your debits before your credits. We already know prepaid insurance is normally debited, but we're doing the adjusting entry. We're now recording what we used as an expense. So we need to go to our insurance. And again, typing out sometimes gets a little bit easier. So insurance. Since we know we're going to credit prepaid insurance, to reduce it by whatever amount, we need to debit our insurance expense. Again, it's sister account. And we're going to credit the prepaid. So again, search insurance, it helps out. So right here, we know it was $1,300. Again, for every debit, there must be a credit. And since we're only doing with 2 accounts, boom, there we go. Insurance expense and prepaid insurance. Question 2. And again, I'll hit click and check my work. Again, you can hit check my work in between the 2 and see if you're correct with A before you jump to B. But I'm going to save that till the end. It's a little bit easier as these videos progress. And I'm always looking for comments on these homework videos, so just let me know, and feedback is always good. So, part B, Zim Company has supplies account balance of $5,200. Okay. On January 1st of 2017. During 2017, it purchased $21,000 or $2,100. Just bear with me. $2,100 of supplies as of December 31st, 2017. A supplies inventory shows that there is 850 of supplies available. So it wants us to do the journal entries. Record the supplies used during the year. Alright, so it's not wanting us to do the addition of the supplies, but how much was used. So my best bet to tell you right here on this type is basically do a T chart, T account. So I end up pulling up, for the video itself, I pulled up a paint program, and we actually want to do a T chart. So, and sorry if this is crudely done, but here's our T chart for supplies. Supplies. Oh, okay. There we go. I wanted the dog. Have to have the dog and the eye. Alright, so this one started off that said 5,200. Whoop, we are doing the wrong spot. So, let me see if there's an eraser. Eraser. Always using a new program. There's no eraser. We'll just do it in white. There you go. Goodbye. Easy thing with paint. Okay, so with these, now supplies is normally debited. So when we do the beginning, we have to put it in the debit side. So again, debits are over here, credits are over here. So for this problem, we have 5,200. And then it says that additional 21,000 was purchased. So since 21,000 was purchased, that's an increase to this side. But we ended out with 850. So 850. Rock on. So with this, we know this is a lot lower than these two combined. So that means we're missing out basically Oh, I wanted red. It did not give me red. There we go. We're dealing out with a missing credit because basically whatever is right here should reduce. So now we can actually come out with the calculator. The thing is, doing a T account will actually help you out to see what's going on. So with this being said, we can take the calculator and we can put in the 5,200 that we started out with, add 2,100. Now, since we know the answer is 850, but we're missing the part to subtract completely, using algebra, basically just flip that. So take the 850 and subtract it from the total of these two. That will figure out the missing link that's right here. So, minus 850. And I should actually have 6,450. That should be my credit. So 6,450 should actually be right here. So 6,450. And again, you can actually check this out and basically put in the math. So if I put in the math, 5,200 plus 2,100. This time subtract 6,450. I should come out to 850, which I do, which is the ending balance. So going back to the homework, we want to record the supplies. So again, we do the expense first because that's going to be my debit. So I'll search supplies. And notice that there's a lot of supplies this time around. So we basically just want to do regular supplies since it does not give us a specific account. So supplies expense for the 6,450. And then credit supplies of the 6,450. Now, you can hit check my work. Boom. Everything's correct. We're good to go. And we're going to move on. Again, supplies is going to be more of a trickier account. So you want to watch out what's happening with that account itself. So it's always good to do a T-chart when you're just confused of how it goes. But if it mentions an ending balance, this is the way that we would like to do it. So if it deals with the ending balance, sometimes this just helps out to see what's missing and how things work. Again, knowing debits and credits helps out. Now here comes question number 8. Question number 8, as you can see up here, what title itself says adjusting for depreciation. So we're bringing in depreciation. How is it working? How does it happen? And we have two examples. One, we again have Barga Company. So again, as you can see, it doesn't give us a journal entry. So we're going to do it up here. So Barga Company purchases $22,000 of equipment on January 1st, 2017. The equipment is expected to last 5 years and be worth $2,400 at the end of the time. We have Welch Company purchases $10,200 of land on January 1st, 2017. The land is expected to last indefinitely. Prepare the entries to record 1 year's depreciation expense of $3,920 for the equipment and what depreciation adjustment, if any, should be made with respect to land account as of December 31st, 2017. Cool. So again, they've calculated our depreciation already. So we don't have to worry too much. But basically, this is the formula that you would have used. We would have taken the 2200 minus the 2400, their salvage, and then divide that subtraction by the 5 years. So just to show you, because you do need to know this, take the 2200 minus 2400, then take the answer and divide it by 5. So again, this calculator just does it in scientific notation, but 3920, that's exactly what they had. So everything's good. I just want to show you basically how it looks like in the calculator, how we would have done it right there. Okay? So with that being said, we're going to do the depreciation first for the equipment. And notice again here in red, if no entry is required for a transaction event, select no journal entry required. Okay? So record the first one. Again, the journal entry for depreciation is always going to be the same. It's always going to be depreciation expense. And it's always going to be accumulated depreciation for debit and credit. And we just put in the amount of depreciation. So 3920, 3920, and boom, that one's done. Cool. Go to now. No, I will tell you this. Sometimes Connect will show you these hints like crazy. Right here, it does say record depreciation adjustment on land if any. No, notice with one, it doesn't even put if any. Here it's trying to just like tell you, hey, I may need to check this out. Again, with land lasts forever, so that you do not depreciate it. Does not get depreciated at all. So even this big old red spot right here says if there's no depreciation, nothing that we need to do, we need to put no journal entry required. So right there, no journal entry required, all done. Again, check my work. Boom, answer is correct. And we move on. Okay. Now we get accrued salaries. Yay, accrued salaries. So, again, we're going to record salaries that are not yet paid. So we need to probably read this and kind of go through this one. This one looks like a lot of words. So, Molly Mocha employs one college student every summer in her coffee shop. The student works the 5 weekdays and is paid on the following Monday. So, for example, a student who works Monday through Friday, June 1st through June 5th, is paid for that work on Monday, June 8th. Okay, big thing right there. The coffee shop adjusts its books monthly. Okay, so it just means at the end of each month. If needed to show salaries earned but unpaid at month end, the student works the last week of July, which is Monday, July 28th, through Friday, August 1st. Now we can actually see we're progressing through the month. So since they adjust their books monthly, here's our first adjustment. We know that something's going to happen. Friday starts a new month. So now we have Monday, Tuesday, Wednesday, and Thursday. So we have 4 days here to get to Friday. If the student earns $190 per day, what adjusting entry must the coffee shop make on July 31st? So, if they make $190 per day, we know it's 4 days that are left in July starting on Monday. We're going to take our calculator. Let me clear all this out. I'm going to take the 190, the salary that they earn per day, and basically times that by 4. So that means we accrue $760 for that week. So go into here. So this is a big thing right here, was the 190. And so on July 31st, we're going to take, again, we owe this to our employee. So since we owe, it is a payable. But payables, this payable is increasing. And notice that payables will always be a credit. So we know that account. Again, the other account is just a sister expense account. So again, salaries expense, debit for the amount that we had, which was $760. And boom, check my work, make sure we did the math correctly. It is done correctly. We are good to go. Remember, with these journal entries, if this was wrong, always hit return and then hit that X, and it will pop it back into the workable place that you can use. Okay? Question 10. Now we're going to prepare adjusting entries for a lot more journal entries. Woo! So a lot of these we've already kind of gone over. So with that being said, and again, to kind of test to see where you're at, I'm going to let you do the journal entries for a lot of these. Go back to the other questions that deal with that particular type. Okay? So with question 10, starting with A. A is dealing with depreciation on the company's equipment for 2017 is computed to be $1,700. So that one was, I believe, question 8. So it's going to use this journal entry right here, except it's only going to use $1,700. Okay? That's how this one's going to be worked out a little bit. Okay? If I see something that we haven't done really before, I want to go over it in these type of questions. Okay? B. The prepaid insurance account had a $7,000 debit balance at December 31st, 2017, before adjusting for the cost of any expired coverage. Alright? An analyst of the company's insurance balance showed that $1,710 of unexpired insurance coverage remains. Okay? So this one right here, this one says, basically, I'm going to do a new one right here. Alright. So this one, if I put here, I'm just going to put PI for our prepaid insurance. Okay, so this T-chart, this is how, again, this is how you build these. So again, I'm not doing the depreciation one. I'm only doing part B right now. So with this, it says it had a $7,000 debit balance. So 7,000. And that it now has 1,710 expired. That's unexpired, meaning we haven't used. So 1,710. So this is one that you have to watch out for, because this is getting tricky of how they worded it. So when it's unexpired, that means we still have a balance in that account. So T-charts again, work out. This shows that somehow it went from 7,000 debit to 1,710, which again means that there's probably a credit that's running around here to reduce it down to this amount. So with that being said, I can take the 7,000 minus the 1,710, because basically if I subtract out the ending balance from the beginning, that should give me what basically reduced it down to that amount. And we find out that our prepaid insurance should be $5,290. So again, if I go to B, which I like this one, now it's actually showing it. So again, this one looks more, it's going to be more like question number 8, which we just plug in this amount, just do the same journal entry for depreciation. Here, we again have our insurance. So insurance expense, prepaid insurance, and it's going to be the amount that we calculated, $5,290. $5,290. Okay, cool. So the reason why I did this one again is just because of the wording. So watch out when it says of unexpired insurance coverage remains. That just means the same thing as ending balance. So take that, the beginning minus the ending, should get you the amount that actually needs to be adjusted out. Question 3, let's see. Office supplies account had a $490 debit balance on December 1st, and $2,680 of office supplies were purchased during the year. The December physical count shows $578. So again, this one looks more, this one actually runs the same thing, as of course I'll go right to it, as our prepaid. We're doing exactly this one again, just exactly how it does. So go ahead and go back in this video if you need to go through the cycle of that basically part. Okay, so let's go back to our question at hand, question 10. And this is what's going to happen when you go back and forth. It actually just shows the journal entry. So again, you want to hit the X because it automatically saves the journal. And see, let's go at 4, see if 4 works anything different. 4, it says 1/4 of the work related to 11,000 of cash received in advance was performed this period. Okay, so with this right here, basically 1/4 is stating that 1/4. So this one's our unearned revenue change, okay? Because we received this cash in advance, so we know this is in unearned revenue, but we actually only had 1/4 that we've actually completed. So again, this is more related if you want to construction jobs. Construction jobs tend to happen a lot with this, with unearned. But when you get to an intermediate, you get to experience a lot more fun stuff with this. So we're going to take the revenue, and basically you're going to multiply this by 1/4. So you can put in parentheses 1 divided by 4, or basically times it by 0.25 if you know your how to do the percentages, and that will tell you how much we've actually earned. So we've earned $2,750. So with this one, again, the journal entry for anything that we've received in advance for unearned revenue, but now have earned it, we're going to have to reduce unearned by that amount of $2,750. And since we've earned it now, notice how I've always say earned, because that's how you need to picture in your brain that when it's earned, it's a true revenue now. So Connect only has revenue this time around. It doesn't have a specific, so that works for us. And that's the journal entry for unearned revenue with revenue. Again, with the way that Connect wants to actually set. Just again, the key word is that we've already received the cash in advance. That's how I know that it was unearned revenue. And again, it's also because we only did 1/4 work related, cash in advance. And basically we've already received the money. So it's just picturing what is going on, analyzing the transaction. All right. Transaction number 5. This was prepaid insurance. Looks like we have another prepaid insurance. Alright, so with this one, again, wording. The prepaid insurance account had $5,800 debit balance at December 31st, before adjusting for the cost of any expired coverage. An analysis of insurance policies shows that $4,090 of coverage had expired. Notice the keywords there. This one says it had expired. So this basically gives us our number right here. So we can actually go insurance expense, prepaid insurance, and go 4090. So the question is, why did I take it? Well, because this one already gave me that said this has expired. We haven't done the adjusting entry for the 4090 yet. On part 2, this one says that there's 1710 that's unexpired. So this one's still going on till next year. This amount is not. Now, if I want to ask you how much is left in the account after the 4090, that's not considered an adjusting entry. That's just telling me what's the ending balance. So I can take 5,800 minus 4,090, and that will be basically my ending balance. It will not be the true amount. So watch out, that one's trying to trick you right there. You have to pay attention to the keywords of what's going on. So if it says anything about has been expired, then that's basically the adjusting entry. If it says it's unexpired, that's your ending balance. Okay, question 6, we have wage expenses of $6,000 have been incurred but not paid as of December 31st. So again, this is kind of like question number 9 here, except it actually gives you the number. So again, with that being said, since it gives me the number right here for 6, all you have to do is put in the same journal entry, so salaries expense and salaries payable of $6,000. Done. Again, always hit check my work. Everything's correct. And remember, it does say answer is not complete because we didn't do 1, 3, and 6. So, again, after you hit check my work, always hit the X so you can go back to the ones. But that's basically 10. Again, go back to some of the other questions if you've already completed them and got them correct. And you're going to use the same journal entries. You're just going to basically plug in the numbers that is. This one, you got to do the same math that you did with question 7. Okay? Alright. So again, we're dealing with prepared journal entries. If this one has anything different, well, I'm going to go over it. If it doesn't, I'm just going to keep going. So, and if you do have questions about these, if you're just having trouble, you are more than free to send me an email. You can even put a comment in the YouTube video. I probably will still answer it, but that's up to you. So, again, let's see what's going on. First one. Wages of $5,000 are earned by workers but not paid as December 31st, 2017. That again is the same thing as question 8. Same thing as part 6 of question 10. So that one I'm not going to go back over. Same thing with depreciation on company equipment for 2017. Again, this is just depreciation. Here, you still go depreciation expense. You go accumulate depreciation, fill in the amounts. Okay, debit, credit. 3, the office supplies account was $330. So this is the same thing as part 2, well, part 2 of part 7, or question 7. So again, T-chart, T-chart, T-chart. Always do the T-chart with the way that these are run. Okay. 4, prepaid insurance account had $5,000 balance. Up, there's that unexpired. So again, this one's going to look again like question 10, going right into part 2. So we're going to do the same steps that we've done here. Again, watch out for the unexpired. So basically subtract the 2. You should be good to go with question 11. And let me wait. There we go. So right there, 3, same thing, subtract 2, or 4, yeah, 4, subtract 2, you'll be good. 3, if you want to look at the math, we have debit balance, add that, subtract that, will get your amount, and you just need to go back to the journal entries whatsoever. Alright, let's see, question 5. The company has earned but not recorded $600 of interest from investments in CDs for the year ended December 31st, 2017. The interest revenue will be received on January 10th, 2018. Now this, again, this time this one's an accrued revenue. So most likely somebody owes us this interest, correct? So, with this, since someone owes us, one, let's see if there's anything with interest. There is interest receivable. These are usually receivables when somebody owes us. If Connect, now I've learned this with Connect, always trying to do what it's related to. This one's related to interest. If it's related to a customer, it will be accounts receivable. But if Connect does not have the name right here, then most likely they're just going to the basic one, so accounts receivable. Here we have interest receivable. We're going to have probably interest revenue, because we have to recognize that interest. And then, of course, any receivable is going to be debited. Notice, we don't credit a receivable until we receive the money. Okay? For right now, that's the only way we credit a receivable. So 600. And I'll check my work after I look at 6. So 6 has now a company has a bank loan and has incurred but not recorded interest expense of $4,000 for the year ended in December 31st. Alright, so we had interest receivable with 5. With 6, we have interest basically expense payable. So again, expense goes first. Interest payable. Again, since we're accruing the interest off of a loan, it's going to be a payable. Again, we owe the bank this interest. In part 5, we were supposed to receive cash or receive interest from the bank, basically for that CD. So we're receiving interest. Here, we're paying interest. So again, we'll put in the amount that's shown. And then hit check my work. I just want to show you, again, look, Connect is not going to show these as red X's. They're going to stay blank. So you have to realize that you're missing amounts if you're missing amounts. But notice here with part 5 and part 6, again, they're dealing with interest itself. So that is mostly my focus with this one. The other parts 1 through 4 we have already done, so you need to go back into your homework or rewind the video a little bit to get into those little few. Okay, let's go into 12, see what other items that is coming right towards us. So the Demetria Company reported net income of $66,025 and net sales of $665,000 for the current year. Calculate the company's profit margin. Okay, so do we remember what profit margin was from part 1 of our videos or from our notes? If you notice, that should have been net income divided by net sales. And again, always check your work. We're good, right? I just like showing the formulas first sometimes. So, put in our numbers, 66025. And the reason why we show you these ratios, because you definitely know these are going to pop up either on the quiz and definitely on the exam. It's not guaranteed on the quiz, but on the exams, probably going to see it. So again, fill in the blanks. Boom. They have a 9.9% profit margin. Woo woo. They're doing well on sales. They're getting a lot more of their cash back or their sales back than going out to expenses. So 12, after the doozies of 10 and 11, it's a little bit easier. So 13, 14, 15, 16 are probably going to favor more closer to the end. This one's dealing with adjusted trial balances. So the following is the adjusted trial balance. We want to prepare our statements. So again, like in chapter 1, here's our statements coming from the adjusting entry. So first one, income statement. Again, here it actually labels it for us. So this is all we're looking for. What is my revenues? Well, up here, if you remember from our way trial balances are, or starts off with assets, then gets into liabilities, then equity, and then revenue and expenses. Notice that our only revenue is trucking fees earned. Again, keyword, earned. So then I'm just going to list. So trucking, there we go. Eventually it shows up. So trucking fees earned, and it's 112,000. So 12. So just like in chapter 1, we're going to do the same thing. We're going to put in our expenses. So here, depreciation expense is the first one. So depreciation expense trucks, 24,448, 24,448, boom. And then again, we go list them down as they go. Most likely again, watch this one. Right here, the blank under total expense. You want to see net income or net loss. This is positive, which most likely probably going to be is, you'll put net income. If it happens to be negative, you just one of the lucky few that get negative, you put net loss. Again, we're going to list them all out. So, again, I'm not going to go through the whole aspect here. Just look at this. 1, 2, 3, 4. We have 1, 2, 3, 4. And then 5, 6. So there's 2 extra blanks right there. So again, watch out. Connect wants to basically trick you with the extra blanks. So make sure you just do the expenses like it is. Okay? So let's go to required 2. Required 2 again. wants you to basically put in the amounts that go along with the statement of retained earnings. Notice that the retaining earnings account is $164,204 at December 31st, 2016. So since it's using the prior year, that is going to be my beginning amount this year. So 164,204, 164,204. My expense, well, not expense. Basically, I'm going to either add or subtract depending on if I got net income or net loss. Most likely, if you have net income, you're going to add. So I'm going to look at required 1. And whatever this amount is, after I fill in all the expenses, I'm going to put in to right here. Just like your statement of retained earnings, those questions in Chapter 1, they're repeating right here. Last part, I'll always subtract out dividends. And dividends right here is 19,000. And again, notice that Connect is doing the math for you for the ending balance. Just be wary, okay? And that's it for question 13. So let's move on to 14. 14 gives us a cool company that everybody should know, Nintendo. If you don't know Nintendo, where have you been? But Nintendo is showing the actual revenue and expense accounts for the recent March 31st fiscal year end, and it's showing it in yen, so their actual currency in millions, and we're going to enter every answer in millions. So nothing too bad here. So all we want to do is do the closing accounts. Okay, we're not going to do anything kind of crazy here. So if we look at here, this is our revenue. These are our expenses. So I like this. View transaction list. Record revenue accounts. Record closure of expenses. We're not doing too much here. We're only doing 2 of the steps of closing entries. So if we know net sales is this amount, that's what we're going to put in. Now again, since revenues is naturally credited, we must debit them to close. So we're going to put in net sales. We're going to debit for the million, 1,968,622. 1,968,622. And we use our new account, income summary. And it's going to be the credit, 1,968,622. So always remember this when we close out revenue. It's always going to be, the revenue is going to be debited. Income summary is going to be credited. Number 2. Second part is dealing with expenses. So it's the last 3. So with that, income summary is always going to be first. We don't know the amount for income summary yet. We just want to list our expenses. So cost of sales, advertising, and other expenses. So cost of sales, advertising, and other. And basically we just put in the amounts, 1,834,981, 1,834,981. Advertising expense is 118,708, 8,708. Office expense is 397,444, 397,444. And then with all those, we can add them up, and that will be your income summary. So again, let me see if I can just go make it a little bit easier. Nope, that does not work. So 1834981 34981 plus 118708 118708 plus 397444 397444. Enter. We have 2,351,133. 2351. 2351. As you can see, sometimes it takes a little while to do these back and forth. So 2, 3, 1. See if I got that right. Probably not. I was off. So 2, 3, 5, 1, 1, 3, 3. There we go. And then check my work. And boom. There we go. So 14's all about just the first two steps. So figuring 15 is probably going to have all 4 steps. So going next. So again, we're running into the same steps. So we want to first look at our revenue accounts. So December 31st. We want to look at this. The ledger of my company includes the following accounts with normal balances: common stock, dividends, service revenue, wages expense, and rent expense of whatever amount they are for you. For me, here they are. I will tell you this: knowing your closing entries. We know closing entries only deal with dividends, revenue, expenses. Okay? And they're going to deal with retained earnings and income summary. But the last 2 accounts we close into. So the three types of accounts that get closed out, again, are dividends, revenue, and expenses. So looking here, I can already cross out common stock, not going to deal with it. So again, first step, let's get rid of our revenue. So again, we have to do the opposite of its normal balance. Since they're normally credit, we have to basically debit them. So revenue, service revenue is always going to be first since it's our debit, 2100 or 21,000. We get basically income summary of the same amount. Cool. There's our revenue, already done and set for. So question 2. Now we close out our expense accounts. And I like that these are actually says revenue to help you out. These say expenses, and it says close out, so forth and so on. Now again, expenses are naturally debited, so we must credit them. Well, we have to start off with our debit account, at least in our journal entry. So that being said, again, income summary is going to be my debit. We only have wages and rent. So wages, rent, and we have 12,400. So 12,400. We have 3,200. And then the total of those two together is, looks like 15,600. And boom. Remember, debits and credits must always balance. So if I only have one account that's going to be on my debit, or one account on my credit, but multiple on the other, add them together. They have to stay in balance. Okay? So, there's my closing. There's my for my revenue and my expense. Now it moves to 3. Now we have to close the income summary account. Now again, best thing to do here, if you want to, is do basically T-chart. So again, I'm going to do a T-chart. I know this is in red now, but so income summary. We'll go back to black. Okay, so we look back into our problem and we notice that the first one, income summary, we did a credit of 21,000. So I credit 21,000. Okay, now we look at how much we close out on the expense side. Again, you can do check my work to make sure you're correct before you get to this step. But there's so few numbers, you may be good and may be confident, but if there is something that you're worried about, always hit check my work. But we did debit 15,600. Okay, so definitely we know, just judging by this, our credits outweigh our debits. So that probably going to mean that this is going to be a credit balance. So if I already know this before I do math, I can go to my journal entry. And basically debit income statement, and we're going to credit retained earnings. But let's go ahead and do the math right here. So if I want to, I can do the simple math. 400 gets me to 600, or 16,000, now 5, so it should be about 5,400. Okay, and since it's going to be more on the credit side, again, it'll be 5,400 right here. And then to close this out, we must debit by 5,400. So again, the first thing is do the T-chart to get your two amounts there, to get your ending balance, and then basically do the opposite of that one when we do this journal entry. And if you're worried about here, you can always jump to the calculator, go 2100 minus 15,600, and boom, 5,400. So here, since we know income summary is going to have to be debit, because we saw it here, credit is the best, or basically it's a credit balance, and then to get to 0, we have to debit it. That's why on the closing entry, it's a debit right now. And it always closes out to retained earnings. Because again, with these, if I go back to this one, preparing financial statements, the last two closing entries is doing this financial statement again. We're basically adding our net income, and we're taking out our dividends. So back to 15, let load up, close that out. So again, part 3, we put in the 5,400 and 5,400. Okay, now closing entries are the hardest little part, adjusting and closing, so make sure you do know this chapter inside and out. It will help you out in the long run. Alright, 4, again, now we close our dividends account, probably the easiest one. Again, dividends is a debit, naturally debit, so we must credit it to get rid of it. And retained earnings is our debit. So of whatever amount, so 1,200. So 1,200, 1,200. Boom. Check my work. Let's see if we got everything right. We do. There's all of our accounts. Good. totals are correct. Everything's good with 15. So 16. Current ratio. Again, first thing we gotta do is do the formula, which, if I remember right, again from your notes, and again if you want to use the hint, it's all about currents. So it should be current assets divided by current liabilities. Let's check my work. Yep, cool. Again, if you happen to switch them, just switch them back. Current assets divided by current liabilities. Again, we want to make sure our liabilities can divide into our assets. So here we run into the kind of problem that you may see is what is our current assets and what is our current liabilities. But first off, take out anything that you definitely know is going to be greater than a year. So let's start off. Accounts receivable. We know we expect to be paid within a year, so that's a current. Accounts payable. We expect to pay our people, pay whoever we need to pay within a year, so that's a current. Notice this is current asset. This is a current liability. Buildings definitely last longer than a year, so that's a long term, not going to be used. So X off. So that's gone. So basically, if you want to take a screenshot and put it in Paint and just exit out, you can. Cash, we definitely know we're going to use cash within a year, so that's a current. Long-term liability payable, that's right there is a long-term, so that's not going to be current. Office supplies and prepaid insurance, even though it's prepaid, we're most likely expect it to be done within a year. So both of those will be considered current. And then of course, unearned service revenue, that's a current liability. So basically we just want to add up our current assets and our current liabilities. So again, accounts receivable, let me clear this out. Account receivable was 29,500. So 29,500 plus cash of 7,200. 7,200 plus, let's see, the next one, office supplies, 4,700 plus what happens to be our prepaid insurance of 4,280. 4,280. So our current assets are 45,680. 45,680. Cool. So now we add our current liabilities, which happens to only be accounts payable and unearned. So 19,500 plus 5,400. So 19,500. Let me double check. 54. Yep. So we only have liabilities of 24,900. And it's supposed to be about 1.83%. Again, check my work. Boom, everything's good. Rock on. So the one problem with this question is basically defining what's current and what's long-term. Again, it looks like the only two long-term items right here is buildings and long-term notes payable. So if it's a fixed asset, probably kick it to the curb. If it actually says long-term in it, kick that to the curb. And then basically you want to total up whatever's your assets and whatever's your liabilities. Okay? So that's it of Chapter 3 homework. Again, if you have any questions, You can leave them in the comments if you go to YouTube, or you can just send me an email. Either way will work. I will respond as quickly as I can. Alright? You have a good one, and I will see you in the next video.